Most beginners don't lose money because the market is unfair. They lose money because of invisible mistakes. Mistakes that feel smart in the moment, but expensive over time. If you're new to investing in 2026, this video might save you years of frustration. Stay with me until the end, because I'll break down the exact behavioral traps that cause beginners to lose money, and how to avoid them using simple structure. First truth, beginners don't usually lose money from lack of intelligence. They lose money from lack of system. Investing without a system is like driving without a map. You move, but you don't progress. Mistake number 1, chasing what's already popular. A stock goes viral. A market spikes. A headline explodes. And beginners enter late. By the time something feels safe because everyone is talking about it, the risk is often higher. Avoiding this is simple. Don't invest based on excitement. Invest based on allocation rules. Structure reduces emotional timing errors. Mistake number 2, trying to double money quickly. This is the silent trap. Beginners often think, if I can just double this small amount fast, I'll scale later. That mindset leads to overtrading, high volatility assets, emotional decisions. Investing is not about speed. It's about sustainability. The market rewards patience more than urgency. Mistake number 3, no diversification. Putting all capital into one idea, one stock, one trend, one prediction. When that single position drops, confidence drops with it. Diversification doesn't guarantee profits, but it reduces catastrophic risk. And risk control is survival. Mistake number 4, reacting to every market move. The market moves daily. News changes hourly. Beginners check portfolios constantly and react constantly. But reacting is not a strategy. Long-term investing is built on allocation discipline, not headlines. Mistake number 5, investing without understanding risk. Every investment has risk, but beginners often focus only on potential returns, not volatility, not time horizon, not drawdowns. Understanding risk tolerance is more important than chasing high returns. Because if you panic and sell at the wrong time, loss becomes permanent. Now let's talk solutions. How do you avoid these beginner traps? Step 1. Build a simple allocation plan. Before investing, decide how much goes into diversified exposure, how much into higher risk ideas, if any, and stick to it. Rules reduce emotion. Step 2. Focus on long-term compounding. Compounding doesn't look impressive in year 1, but over time, it becomes powerful. Reinvest dividends. Contribute consistently. Ignore short-term noise. Time in the market generally matters more than timing the market. Step 3. Automate what you can. Automation removes emotion. Scheduled investing. Predefined rebalancing. Clear risk limits. Systems protect beginners from themselves. Step 4. Measure progress annually, not daily. Daily checking increases stress. Annual review increases perspective. Zooming out reduces panic. And calm investors make better decisions. Here's the real reason most beginners lose money. Not because markets are impossible, but because they treat investing like a shortcut. Wealth is not built through excitement. It's built through ownership. Ownership of diversified assets. Ownership of discipline. Ownership of time. Remember this: income pays expenses, but structured investing builds leverage, and leverage builds options. If you avoid the common beginner mistakes, you don't need to be perfect. You just need to be consistent. This video is for educational purposes only, and not financial advice. Always do your own research before making investment decisions. If this helped you understand the psychology behind beginner investing mistakes, subscribe for more structured insights on building long-term assets safely and intelligently. And remember, the goal isn't to win fast, it's to survive long enough to compound. I'll see you in the next one.